The takedown was to some extent orchestrated and manufactured. It seems apparent to me. As you know, I'm somewhat resistant to wild theories and conspiracy theories, but this it seems pretty clear to me.
Wait, did 40-year industry veteran Brien Lundin just say the gold market has been manipulated? Stay tuned. Welcome to the Main Street Capitalist Show. I'm your host, Russell Gray, and I am super excited to bring to you a good friend of mine, a guy known for a long time, one of the icons in the precious metal space. And if you haven't been paying attention to precious metals, and I don't know how anybody who follows me couldn't, because I have really felt for the longest time that what was going on in the currency markets and the bond markets would lead to a lot of upward pressure on precious metals. That's exactly the way it's played out. Some people think I'm smart, but I'm really just informed, and a lot of the places where I got that information was at the New Orleans Investment Conference, and you're about to meet the promoter and producer of the New Orleans Investment Conference and the publisher of Gold Newsletter, Mr. Brien Lundin. Welcome to the show.
Hey, Russ, great to be with you. I'm trying to get over being called the icon or an icon. You know, I still think of myself as one of the young guys in the market in my head. But when I look in the mirror, I realize that there's been a long, hard road has been walked in this sector. And so, yeah, that kind of set me aback. But yeah, it's been a while.
I'm right there with you, obviously. Yeah. We're contemporaries, if you will. I think we're almost exactly the same age. But, you know, with age comes perspective. And you've been in the precious metal space and watching the economy and the financial system and the dollar and hearing all these brilliant speakers year in and year out. I mean, how long have you been running the New Orleans conference?
I guess I was running Jim Blanchard's business since 1990. And started working for him as a junior copywriter in 85. And Jim, of course, was the guy who started everything I do today, Gold Newsletter, New Orleans Conference, really in reaction to Nixon closing the gold window and severing the dollar's last remaining tie to gold in 1971. And he got gold legalized, actually, for American citizens in 1974. So, I've been running it, I guess, since 1990. I've been owning it since the early 2000s. Jim passed away in 1999, and just been trying to continue the legacy and burnishing it where I can ever since.
Well, I think you're doing a great job. You know, I discovered it after going through 2008. Sometimes people get bored hearing my story, but there's so many lessons in loss. The bond market collapsed. I was in the mortgage business. And so when the bond market collapsed, it took the mortgage business with it. And mortgage-backed securities were kind of at the epicenter of that. And I learned that macro does matter to Main Street. I wasn't comfortably sequestered from the shenanigans on Wall Street. And I noticed that gold operated inversely to what was going on with real estate, which was the focus of my attention at the time, being the co-host of the Real Estate Guys radio show for all those 20 years. And so I started looking at that and realized I better understand gold. And so we came to your conference for the very first time, probably, to 2010, maybe 2011, 2012, something like that. Yeah. In that range, and just blown away at the quality of the speakers and how much I didn't know. But over the years, I've learned, and you've been kind enough to put me on stage now more than a few times on some pretty prestigious panels, and I appreciate that. But it has really helped inform my financial strategies in terms of being prepared for whatever comes. Peter Schiff has been talking about the next crash. And so I want to talk a little bit, because you have this perspective, you have this broad Rolodex, you're connected to everybody there is in the space. I think as we're recording this, and I'm going to turn this show around as quickly as I can, but within the last week or two, depending on when anybody's watching this, we saw gold and silver just spike up to nosebleed, unbelievable, hard to understand what was going on, unprecedented levels, take a big hit within a few days after that, and now the term is called consolidating, just kind of vacillating, waiting to find their next new direction. From your take, what is going on? Is this just rinse and repeat, same old that you've seen 1,000 times, or is this time it different? If so, how and where are what is that saying about what's happening in the world and in the economy?
Yeah, it as to why we had that decline, had that sell off. It was a little bit of everything. There's been a lot of theories and a lot of conspiracy theories and ideas thrown out there, but I think it was really a combination of a lot of things. The market had risen so quickly; there was a lot of froth in it, even though it wasn't driven by retail or even Western traders as much as it was demand and really overwhelming demand globally. But still, it had gotten ahead of itself. It was running so quickly that it was almost bound to trip up at some point. That said, the nomination or decision to nominate Kevin Warsh as the next Fed chairman by Trump was supposedly the trigger for this big cascading sell-off. I don't believe that was a trigger or a worthy trigger, because Warsh was in all of the polls and betting sites was the first or second choice, to be chosen. So it wasn't a surprise that he was chosen. And the takedown was to some extent orchestrated and manufactured. It seems apparent to me. As you know, I'm somewhat resistant to wild theories and conspiracy theories, but this, it seems pretty clear to me.
There you go. There you go.
Tinfoil.
I am much more in the camp of thinking there's shenanigans going on, and but this isn't about me and my opinion. But are you suggesting that perhaps you're opening to the idea that some market manipulation goes on to protect some big players?
Yes, I am, and that's why I wanted to position it as my somewhat high level of skepticism that even I can see it in this case, and the evidence is pretty compelling. Number one, you have Warsh was not really a big excuse. Number two, you had the exchange raising margins on trading silver and gold right up until the sell-off, and kind of triggering the sell-off of the last 35% increase in trading margins. And then you have the fact that on the way down, if the price of any asset falls by 10% in an hour, there are circuit breakers supposed to be triggered on the exchange. Well,
supposed to be being the operative word.
None were allowed to be triggered, so they were in search of lower prices. And that obviously implies that they were trying to get a lower price to rescue the people or the traders, the powers that be that had been short that market and were getting slaughtered, at least on a paper trade basis. And so they were kind of rescued by that. But part of that also is the nature of these markets. Is traders know that there are sell stops below the market, so they're going to try and drive a market that is relatively easily manipulated, like gold and silver. They're fairly small compared to treasuries and the like. So a right amount of money applied at just the right time can move those markets. And if you can trigger a sell stop that gets downward momentum, it can trigger another sell stop, and bam, 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 there you go. So that's really what happened. I came out fairly publicly in the aftermath saying it was going to take at least Monday of forced selling to abate, with margin calls and the like, to get back on track. And it seemed like that's kind of what happened. We got back on track yesterday as we speak, on the Tuesday following the big crash. And it seems like, we are having a halting rebound, at least a recovery. None of this obscures or eliminates any of the fundamental driving factors of this bull market. One of the primary ones, if not the primary one, being central banks buying gold and selling dollars to buy gold. And gold has actually surpassed Treasury securities as the leading component of international reserves. So that is the big factor. That's one of the factors that makes this bull market unique. Central banks are driving it. We've now seen Asian buyers and even Asian speculators coming in the market. They usually don't follow the price. They usually wait for price declines. They're the bargain hunters that tend to support the market. Western investors usually follow the price upwards. Western investors have been, at least from a retail basis, have been selling into this bull market all along. So this literally is like nothing we've ever seen before. And that has a lot of implications that I think investors, at least, can use to their advantage.
Well, there was a lot there. And so there's a couple of different constituencies out there. I have a soft spot in my heart for Main Street people like I was, real estate guys out there that are just taking care of their business, like I was my mortgage company, investing in real estate, thinking none of this matters to me whatsoever. And then I realized that gold is really like a canary in the gold mine. But it indicates it's a kind of an indicator of the health of the overall financial system. And so as I began to study it, I want to unpack a couple of things you said, and I'll attempt to be brief, but just I want to make sure people don't get left behind. So there are two markets, and correct me if I'm wrong, and let's banter back and forth. I don't want to turn it into a monologue. I just want to make sure we don't lose people, because sometimes guys who live in the space like yours start at a base of understanding that's above the head of some of the people. And I think the more people who understand precious metals, the more people will be able to enter in and use it as a way to protect themselves against some of the problems the movement in the metals is signaling. There's one thing to understand the problem, and that's hard enough. It's another thing to muster up the conviction of courage and courage of conviction to be able to actually rearrange your portfolio to do it, especially when you've got metals at these nosebleed levels, right? In hindsight, it's like, oh, I wish I would have bought it when it was 10 or 11 or 12 or gold when it was 1,500. But now what do I do? So there's two markets specific to the metals. There's paper markets where people are trading futures contracts, and then there's the physical markets where people are actually taking delivery of the metal, right? So that's fundamental number one, right? That's primarily what we're talking about, the two different markets, correct?
Yeah.
Okay. Yeah. And then in the paper markets, those paper markets used to be built to create pricing stability in the physical markets, but then they took on a life of their own. They just became a casino where people who had zero interest in ever taking the metal could just skim dollars, and then they were for speculators to go in there and just chips in the casino to play back and forth.
Yeah.
Along the way, we had fractional kind of like fractional banking enter in, where people could trade more contracts than there was physical metal because people knew nobody was actually going to take delivery. And then that leverage grew really, 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 really big, really big.
Mm-hmm.
And some of that's beginning to unwind. And then the last part of it, you talked about margin. And so the people who run the casinos can change the amount of leverage the players can use. And it's not really fair, because you'll take a position and then they'll wake up one day, okay, we're changing the rules. And now you're either going to be able to buy more with less, or you're going to have to put in more to hold your position or unwind. And the latter forces downward pressure. What I heard you say is that the people who run the casino introduced artificial downward pressure ostensibly to drive the price down. Did I hear that correctly?
Yes, you did. And, in some cases, if there's a lot of speculation and speculative froth in a futures market, then it is valid to to hike margin requirements. So instead of having to put only 5% down, you have to put 10% or 15 or 20% down. So it is a valid tool of the exchange. The thing that the exchange did in this case was switch from dollar amounts per each futures contract in gold or silver to a percentage basis, which means as the price goes up, you have to put up more money. But as the price goes down, it basically made it more pressure on prices to drop, because margins drop as the price falls, and put even a greater restraint on the price rising. So they kind of rigged the game there. As you mentioned, and I think rightly so, a lot of people forget the fact that the futures markets were started as a tool for producers to, a farmer who's got his corn crop coming in next year. If he can get a decent price that guarantees his livelihood, he can sell it forward and guarantee that price no matter what happens. And it brought order and sustainability to a lot of primarily agricultural markets to begin with. Then miners could do the same thing. And of course, they let that out of hand and go out of hand in the 1990s. totally different story. But it did get taken over by speculators and traders. And its function right now is something that serves no usage. No use to any markets, doesn't produce anything. It is just a casino, largely so. Now, I would love if they raised margins to 100% and said there's no leverage at all, but that would take the producers and hedgers, like the coin and bullion companies, like we know, and some of our good friends are involved in. It would essentially cease their ability to work, to trade, to offer product, because they couldn't hedge their inventory, and they would always be susceptible to price drops or price gains. So it would be good to totally take all of the speculation out, but it would really be impossible unless they limited the markets just to legitimate hedgers and producers.
Well, these are conversations about policy, and they can quickly turn into politics, which is the way we think it should be or what's right or wrong. I look at policy, whether it's the policy of the people running COMEX and the futures contracts and how they're going to protect people from extreme runs to the upside or extreme runs to the downside. You said that they triggered the one to stop the upside, but they didn't trigger the one to stop the downside.
Yeah.
So it's kind of like, hey, there's supposed to be a range that we are safe playing in. And it's like you took the rail off the fence and people are falling in the cliff. You're like at the Grand Canyon. You can climb up a mountain or fall in a cave. You're supposed to have fences to protect you, and they didn't do that. They moved the fence and said, "Go ahead and fall in the pit."
Yeah.
So it's kind of scary for people. But I do think that when we talk about policy as investors, our mission is to understand whatever it is we're doing and what the rules of the game are and how policy decisions affect what players in the market are going to do. And that's why it's very dangerous for people who don't understand these markets to get in there and try to trade them, in my opinion. That's why there's a lot of professional traders you put on your stages at New Orleans, and I listen to their level of sophistication and what they understand. I'm like, I'm not going to play that game. So I just try to understand the big long-term trends and then just take positions just based on, an allocation of a balance sheet. And I've always felt like gold, silver, but gold in particular is a great way to hold equity on your balance sheet as a Main Street investor, as an alternative to real estate equity. Equity in like life insurance policies, which takes you outside the banking system. You have equity, what I call equity, you're in the banking system just with your cash balances. You can have equity on your balance sheet in terms of precious metals, and you can have equity in terms of your real estate and how quickly they can be liquidated, how steady their value in terms of dollars. Those are all factors you have to take into consideration. But I, as you know, look at gold a little bit differently than a lot of people that are actually in the gold space. And so that's kind of how I look at it. But the other thing I look at it as is an indicator of the relative health of the currency, of the bond market, of the financial system overall, and then how those factors really indicate what's going on, with the economy. Because if you lose inflation, you're going to have interest rates that change the bond market, that change the credit market. And for Main Street, it all trickles down to, is credit going to be available? Am I going to be able to get a mortgage? What are my credit card rates going to be? Is my money in the bank going to buy the same amount or less in a year from now? When you look at everything going on, just from that lens, where do you think we're at, right? We've heard doom and gloom about the dollar. I sit on your future money policy panel. Some people think the dollar, even though in spite of its recent weakness, is going to be strong. And of course, we've got BRICS and what's going on. Just when you think about the financial system, the ecosystem that Main Street operates in, do you feel like gold is signaling anything one way or another that Main Street needs to be aware of?
Yeah, I absolutely do. But I always take pains to tell people that, as you know, I've watched some of the smartest people in macroeconomics and investments and everything else walk across my stage in New Orleans over decades. Really, really smart people. And I can tell you that, frankly, no one knows. As far as the precise path ahead, no one knows precisely what's going to happen, in what order, and what the timing is going to be. And, anybody that has the hubris to believe that they can figure that out, you shouldn't really listen to them. But thankfully, most of our speakers recognize that. That said, I think there are clear trends that we have to understand here. And everything is going toward a flight from the dollar, at least from central banks and around the world. Politics is a big part of that. I think it's going to be a flight from not just the dollar, but all fiat currencies because of the debt loads that have been built up after decades of ever easier money. Those debt loads now are not manageable at anything approaching what have been historically normal interest rates. So interest rates have to be suppressed. They will be suppressed by the powers that be as they try to be able to manage their debt service and therefore depreciate that debt by issuing more currency, which means inflation. And really, it means the same things that have been happening in cycles over and over throughout human history. None of this is new. This has happened over and over again. Every civilization, every government that has ever existed in human history has eventually overspent its means through entitlements, through military adventures, through the feathering the beds of the politicians and the wealthy, et cetera, et cetera. It's not a new story. It's happening again, and it always ends with the depreciation, ever accelerating depreciation of the underlying currency. That's going to happen, but today in this globalized world that we have, it's not just this case or that case. It's really all fiat currencies because it's all interconnected and all the trends are the same. So the best we can do now, in my opinion, is to understand and recognize the trend. I don't know, as our friend Peter Schiff believes, that the next crisis is going to be the big one and it's all going to blow up. I don't know if it's going to be that crisis or the one after it or the one after that. But I can tell you that the depreciation in fiat currencies, the dollar foremost among them, is going to accelerate in the years ahead. That's why you need to own gold and silver, because it protects you against that. That's your insurance. And as that trend develops, there are ways that you can invest and leverage that trend, primarily through those investments that leverage the monetary metals. There's a base metals and commodities story that's running in parallel, but has different drivers. That's also very exciting to me. But yeah, from a monetary metal standpoint, there's great ways you can leverage it. Futures and options, risky. You have to really know what you're doing. Mining stocks, also risky. You don't have to have quite the skill level. You can invest in indices and the like, or you can, look into it and educate yourself and find some real opportunities there. So there are ways to build wealth, and it's vitally important to use the methods that are out there to protect wealth during these, as this trend progresses.
So, yeah. So to me, I mean, obviously gold is money. Gold and silver are money. It's a place to store value outside the banking system, outside the currency. You can pivot into any currency you want. If the banking system collapses, you're insulated from that. Throughout human history, there's always been a bid on both. So fairly liquid, whatever the currency that's going to get bid is. And so strategically, that's how I think people are going to want to look at it. As a leading indicator, it tells you that people are beginning to lose faith in fiat currency denominated systems. And that's not just here in the United States, but that's all around the world. And so there's a coalition of countries that have gotten together and are beginning to work on putting in together all the infrastructure, bullion exchanges, international banks, big bond markets. And I'm talking about the China-Russia-led coalition BRICS Plus, and their drive that Jim Rickards on your stage many times has been talking about. Donald Trump came out right after he got elected, not even inaugurated, and put the BRICS nations on notice that he was going to slap 100% tariff on them if they went after the dollar. And he did it not once, but twice in the month of November 2024. He hadn't even been sworn in. So that alone told me that it was at least a real threat. I follow it. I talk about it every month. Dana and I talk about it every month on the Investor Mentor Club. I watch it. I've been talking about it for a dozen years. It's a slow moving trend because it's not easy to unseat the dollar, but the dollar's lost market share. The dollar has and gold has gained market share, if you will, as you mentioned earlier, in terms of reserves. You're an advocate for sound money. It sounds to me when I look at BRICS that BRICS is recognizing that they're going to have to come up with something more sound if they're going to win the day. They're not going to be able to be US dollar 2.0, because nobody's going to trust China. They're going to have something people trust. People trust gold. That's clear. Are they making progress? And if they do, are some of the things happening here from our policy, financial policy, even our trade policy, even our military policy? Do you feel like we're engaged in a battle to see who's going to force some form of fiscal responsibility in terms of a sound money globally? Am I crazy for thinking that that's going on, or is there some reason to believe that could be happening?
No, I think you're crazy for other reasons, but not that one. Not that one. No, it again, to me, it's the trend. I don't believe that the dollar's end as the global reserve currency is anywhere in the near future or in any time frame that's relevant to us right now at our advanced ages. But the trend is there, and I think it's because the rule of law. Our friends George Gammon and Brent Johnson call it the network effect. Well, I think the rule of law led to the widespread usage of the dollar, which created the now existing network effect that keeps it on its throne. So I don't think that's going to change, but we have to recognize that globally there is a sell America. There's an orange man's crazy and doing all these, crazy things. And so let's try to insulate ourselves from whatever he's going to do and whatever the U.S. is going to do. And I think it's a recognition of the U.S. debt problem. That's one of the, worst, top 2 or 3 worst in the world as far as nations go, and what that implies. So it's all a big gumbo, a lot of ingredients in it, but it all adds up to why would we want to hold such great dollar reserves when we can hold something that has no counterparty risk and everything else. And conveniently, it's also rising in value against the dollar. So that's why they're moving to gold. Now, globally, you have to get into the mindset of people in other nations. In China, they have the ability not to get their money outside of China, which they would love to do, and some the really rich are able to do through real estate transactions and the like. But if they can't get their money out of China, they can at least get it out of the system by owning gold. And it's hard for us to understand, or for most people in the U.S. to understand, but that's a real motivating factor. And that's why in China, they're buying gold hand over fist at these levels. They're speculating to some degree as well because they don't have a lot of alternatives to invest there right now. But that's a big factor right now in the gains we're seeing in gold.
So that brings up this concept of the bifurcation between the paper market and the physical market, and what some people call the Western market, which would be paper driven, and the Eastern market, which would be physical driven. And the bid, the consumption, the desire for physical metal has really grown substantially over the last several years, specific to central banks and even more specific to the East. And that's new, right? That's different. The last time we had this big run up, we had the Nixon shock, and then gold was trying to find its proper relationship to US dollars, and there was a lot of dollars out there. Gold shot way up, 850. and then sat there in the $350 to $500 range for the purgatory of about 20 years.
Mm-hmm.
And then all of a sudden in this century, it's really taken off. And of course, it's culminated. And a big part of that drive has been the move to physical and price discovery in physical. I mean, as we're sitting here, it's my understanding Shanghai Gold Exchange has got silver like $125 an ounce, and silver's like 85 in the US. How long does that last before people are buying everything there is that exists in the US and selling it in China?
Yeah, there's a real argument that the metals markets are broken right now. There are severe supply constraints and issues in London for gold and around the world for silver. There are a lot of interesting things. The futures exchange, COMEX, in the U.S. is primarily paper traded, paper settled, but there has always been a delivery mechanism there. It was never very prominent, except for over the last year, when industry primarily that needs silver because the above ground stockpiles have been eradicated and eaten away after years of annual supply deficits. The very large above ground supplies are now gone. So industry, for the first time in history, is actually bidding against investor demand for available silver. So there's a lot of silver being delivered via the COMEX. By the same token, in China, you have what were physical exchanges, and they opened up the Shanghai Futures Exchange, which is settled in deliverables, in actual metal. It was built really for deliverability of actual metal. But before that metal is delivered, you can trade it via paper. So that actually has allowed some speculation to emerge on the paper basis in that exchange, which was originally organized to facilitate physical deliveries. And we've seen that have a big impact as well. You know, it all adds up, Russ, that this market, history rhymes, it doesn't repeat exactly. Well, it's rhyming, but there are a lot of differences with this market, a lot of key features that we've never seen before that, you know, are interesting and have some really compelling implications.
So it's fair to say this is unprecedented, even in your 40 plus years in the space.
Yeah. And even, you know, gold has only been traded, despite its 4,000 or 5,000 year history as money, it's only been traded as an investable asset since, you know, globally 1971, in the US, the last day of 1974. So over that period, I have been alive for every bull market in the history of this 4,000 or 5,000 year old asset. You know, I was interested in other things in the 70s as a teenager, but I knew what was going on, and I've studied those markets. And no, we have not seen anything precisely like this ever in the history of gold as an investable asset.
Yeah, and I think that's a really important thing to consider. So we've talked a little bit about the demand. Part of it is industrial. Part of it is financial or speculative investing. You've got sovereign wealth funds, central banks involved. You've got individuals all around the world involved. You've got this separation between paper markets and physical markets. And so that's creating a lot of pressure and changing the dynamic. But when you start actually talking about delivering the physical product, you have to talk about the supply side. It's easy to create contracts, but you talked about metals coming out of COMEX. The problem is that those are reserves, physical reserves, like if you consider in banking, you know, banking reserves. And unlike dollars, where the Fed can just add digits to the bank reserves balance sheet, or through fractional reserve, just remove the reserve requirement, when you actually have to deliver the metal, you can't manufacture metal out of thin air. You can't just add digits to the balance sheet. Yeah. And so as COMEX begins to get emptied and has more claims on metals than there actually are, all of a sudden that creates a real demand problem. Meanwhile, all kinds of metal is moving from west to east. So that brings us back to the production side. Like, where does this stuff come from? And you've been big in the mining industry since forever, and there's different layers of that. You can invest in people who are exploring. You can find people who have reserves that are developing those reserves, and you know a lot more about it than me. And then there's a chance to play on the royalty side, which is like an income stream. So if we have time, and I'm not sure we will, so I may have you come back to talk about that. But I'd like to talk just a little bit about what's happening on the supply side, because when the prices were suppressed and very low for a long, long time, silver at $10.50, right? That for a lot of miners, even back then, that was very near or below the cost of production. You can't produce. You're going to grab the low-hanging fruit and the hard stuff to get to. At today's prices, you can, I would imagine, be able to develop. So what are the prospects for the miners? What are the prospects for a whole bunch of supply being developed and maybe mitigating some of this upward price pressure based on, too much demand and not enough supply? What does that look like? And where are the opportunities for an investor who thinks they may want to explore investing in the mining space, which is your wheelhouse?
Yeah, the old saying is in the commodity business is that the solution or the cure for high prices are high prices, and the cure for low prices are low prices. Because when prices are high, it encourages new supplies, it brings prices down. When prices are low, it discourages supplies, which creates those supply constraints, and the prices rise. So it's cyclical. It is fundamentally a cyclical market. The issue now is that for decades, literally decades, the industry has not reinvested in finding new resources: gold, silver, copper, anything, everything across the board. They haven't done the proper investment. And even in the best of times, it takes a lot of money and a lot of time and a lot of work to find these deposits. And they're getting harder and harder to find. You have to go deeper, you have to go for lower grades, et cetera, et cetera. And of course, costs are spiraling all the time. So we are in a severe supply constraint. There will be a supply response to these sky-high gold prices. The good news for those investing now is that it takes years to bring a new mine on stream. And at the best, you're looking at mines in production, mines we know, mines that already, or projects already down the permitting road, which is another very severe constraint on development. I would guess roughly that we're 5 years away from getting a very significant supply response. We'll get some because the current miners can just go mine lower, higher cost ore, lower grade ore, and provide more gross metal to the market because their margins, their profit margins are still so high. So great. But it's at least, I think, about 5 years away. For other commodities like copper, it's 20 years away. And the demand curve we see for copper is going to, it's not like every big deposit we've already discovered and known that is not yet developed. It's which of those will have to be developed to meet the demand curve. They will all have to be developed and new ones discovered to meet the demand curve coming up. So that's one of the fundamental stories out there running alongside this monetary metal story. That's very exciting to me, and I think presents tremendous opportunities.
So there's a couple of things that little conversation sparked in me. Number one is lag. A long time ago, I wrote a newsletter for the real estate guys I called "Don't Get Lost in the Lag," and that is to understand that just like in real estate, if you all of a sudden you have created incentives for some production to come on, and you think prices are going up because there's a supply-demand imbalance, and you're going to ride that wave, and you think this is forever. If you're not paying attention to that pipeline of production, you may get surprised when all of a sudden this production hits, when inventory hits. And so that's one of the great reasons why to come to the New Orleans Investment Conference and subscribe to the Gold Newsletter, because you're following all that stuff, and people who are managing their reserves with metals in their portfolio from a dollar basis, they're looking at the dollar price, are going to have to realize if a bunch of supply comes online, that could bring down the dollar value of those reserves. And so the lag component, but there's another component I want to ask you about, and that's AI. AI is something that just hit real fast. AI is super energy intensive. Everybody talks about it from power and oil and natural gas and maybe other, uranium and nuclear. But one of the things all of this electricity has in common are the conductive metals that make it all happen. And top of that list to a degree is silver. Do you feel, or have you heard from any of the people in your world that some of this incredible demand or stockpiling of silver by large industrial nations like China and or even large companies, say like a Tesla, and I don't know what any of these guys are doing, but do you think AI is factoring in to what we've seen in this recent run-up in silver in particular?
I think longer term it will. I don't think that AI has created and AI data centers have created the kinds of constraints or on supplies of critical materials yet, but they will. And energy. It takes a lot of energy to run those data centers. Silver is, of course, a component of that. A more important component of it is copper. We look at the demand curve for copper resulting from electric vehicles and the like, and that dynamic has faded a little bit. It's still pretty dramatic, but it's faded a little bit. But then we saw AI data centers rise up, and that's going to more than replace anything that has happened in the decrease in potential electric vehicle demand. Copper is used in the distribution of energy through the electrical grid. It's used through motor windings, et cetera. It's used for wiring of AI data centers. It's said that 6% of the capital expense in building an AI data center is copper itself, just copper, 6% of the cost. So there are tremendous demands on copper, and there are for silver and base metals along the way. Silver is becoming an energy metal, and potentially used in batteries now as well. So their technology advances. The death knell was rung for silver when photography went away for digital photography. We didn't need silver for film. But then we came up with solar panels, and it's just that these metals that have very important physical characteristics, in many cases irreplaceable, technology will find ways to use them, and humans will find a way to use more and more of these materials. So, and the demand is nothing I am worried about. That's going to continue to grow across the board: silver, copper, gold from a monetary sense. It's the supply thing is part of the equation.
The money's going to have to go into supply. There's going to be potentially a lot of opportunity to invest in that. Companies that already exist, have leadership, have infrastructure, probably have been right-sized through some of the lean years, may end up being prospective good values. So I know you talk about that in the Gold Newsletter. Talk a little bit about the Gold Newsletter, how that works, if people choose to subscribe, kind of what they get.
Yeah, Gold Newsletter was started by Jim Blanchard really in 1971 when Nixon closed the gold window as a way to lobby for the return of gold ownership for American citizens. And over the years, it developed into classic investment newsletter where we talk about the macroeconomic situation, or I do these days. Talk about macroeconomics, the markets, the metals, and I recommend and cover a wide range of mining companies, typically junior mining companies on the more speculative end of the spectrum. These are companies that are either exploring or developing projects, in some cases early stage producers. And unsurprisingly, in this kind of a market environment, they've been performing very well. But not as well as they should be. And I think that's important. They were really at historically low levels before this big bull market started. They have, by and large, doubled, tripled, quadrupled in price, yet they still are far from trading at levels appropriate to where the metals prices are. So it's like a generational opportunity that's been handed to investors on a silver platter. We're still in the early innings of this market, and I think we've got a lot further to run. Gold Newsletter covers it all. We give great recommendations. We educate people in the markets. And if if you're going to be involved in this sector, you need to subscribe to either Gold Newsletter or some of the few other really good newsletters out there to help guide you through the sector, because there are risks. There are tremendous potential rewards, but there are risks that you need to be aware of.
Well, I think that right now a lot of people are trying to figure out the next .com. They saw the big Mag 7 ride. Tech has been battered. We didn't get a chance to talk about the bifurcation between Bitcoin and gold, something that Peter Schiff and Larry Lepard get into on that panel. And hopefully I'll be back on that panel between the two of them again this year at the New Orleans Investment Conference. Folks, if you're interested in learning more about the New Orleans Investment Conference, following Brien Lundin, getting into the gold newsletter, email to goldnews@mainstreetcapitalist.com. I'll get you everything you need to know. I'm working on Brien in a couple different areas. My Main Street Media Network is now the official media network for the New Orleans Investment Conference. So super excited about that. We're going to be bringing on many of the speakers who are going to be in next year's or this upcoming conference onto the network and onto this show. So you'll be hearing from them. Also, kind of trying to strong arm Brien into becoming a mentor once a month in the Investor Mentoring Club. So if I'm successful in that, you'll hear about that. And you can follow him for more information about mining stock investing. But whether he's part of our program or not, you can always follow him on Gold News. Just send an email to goldnews@mainstreetcapitalist.com. And Brien, I so appreciate you taking time. I know you're a super busy guy. You got a hard stop, so I'm going to let you go. And I'll get you back on, and we'll talk more about Bitcoin and what's going on in the mining stocks and how to make money in mining and royalties. Okay?
You got it, Russ. As I say, it's a really interesting time full of risk and opportunities, and always available to talk with you and your audience about any and all of it.
Thanks, buddy. You have a great day. Appreciate it. That's Brien Lundin. This is the Main Street Capitalist Show. I'm your host, Russell Gray. We'll see you next time.